Hello friends, welcome back to the channel. If you're looking to improve your trading mindset and gain more control over your emotions while trading, today's video is just for you. We're diving into the book Mastering Trading Psychology by Andrew Aziz. This book is packed with valuable insights on how to handle the mental challenges that traders face. In this video, we'll go through the key chapters of the book and discuss the core strategies to master your emotions, stay disciplined, and improve your trading performance. So, if you want to take your trading to the next level, make sure to like, share, and subscribe to the channel for more amazing content. Now, let's get into it. Chapters will discuss 1. Trading a different kind of business. 2. The power of resilience. 3. Psychological hazards in trading. 4. Psychological safeguards in trading. 5. Staying focused. Build your trade books. 6. Knowing yourself as a trader. 7. Setting goals. 8. A disciplined lifestyle. 9. Conclusion. We're going to break down each of these chapters and discuss how to master your psychology when it comes to trading. This book is an essential resource if you want to learn how to make better decisions, avoid emotional traps, and become a more disciplined trader. If you're ready to improve your trading mindset, stick around as we dive into the psychological tools that can transform your trading journey. Now, let's get started with the first chapter. Chapter 1. Trading, a different kind of business. Traders as business people. Think about this. As a trader, you're not just someone dabbling in the stock market, you're a business person. But unlike running a brick-and-mortar store or an online shop, in trading, you don't deal with physical products or employees. Your primary assets are your mindset, your capital, and your decision-making skills. The book emphasizes that trading should be treated like a business. What does this mean? You need a business plan. In this case, it's your trading strategy. You need risk management, just like a business plans for market fluctuations or unexpected costs. You need to focus on consistency rather than short-term gains, the way successful businesses prioritize long-term growth over immediate profits. Trading is not a hobby or a side hustle. It's a full-fledged entrepreneurial venture where your results are entirely dependent on you. Why start trading? Now, let's address the big question. Why do people start trading? For most, it's the allure of financial independence. Imagine being your own boss, working from anywhere, and having the potential to make substantial profits. Sounds like a dream, right? But here's the reality. Trading isn't a get-rich-quick scheme. Most people fail because they jump in without understanding the psychological and emotional challenges involved. The authors highlight that many start trading because they're drawn to the excitement, the freedom, or the potential for high earnings. But to truly succeed, you need more than motivation. You need discipline, emotional control, and a solid plan. Not an ordinary business. Let's talk about why trading is unlike any other business. In a traditional business, you have some control over your success. You can improve your product, market it better, or expand your customer base. In trading, you have zero control over the market. The stock market doesn't care about your plans. It doesn't care if you need to make money this week. You're dealing with constant uncertainty, and the only thing you can control is how you react to it. Here's a key takeaway from the book. Trading is a business of probabilities, not certainties. You won't win every trade, and that's okay. Success in trading comes from managing losses, sticking to your strategy, and staying consistent over time. Emotional control and dealing with uncertainty in trading. Let's get real. Emotions are your biggest enemy in trading. Imagine this scenario. You've been analyzing a stock for weeks. You finally enter a trade, but suddenly the market moves against you. Your heart races and panic sets in. What do? Do you stick to your plan and accept a small loss? Or do you let emotions take over and hold on to the trade, hoping it turns around, only to watch the losses grow? The book teaches that successful traders learn to detach emotions from their decisions. They focus on the process, not the outcome. This means having the mental discipline to accept small losses as part of the game. Uncertainty is a constant in trading. The market is unpredictable, and no amount of analysis can guarantee success. But here's the good news. You can train yourself to handle this uncertainty by focusing on what you can control, your mindset and your actions. Trading versus poker. Here's an interesting analogy. Trading is a lot like poker. In poker, the best players don't win every hand. Instead, they focus on playing the odds, managing their chips, and staying calm under pressure. Similarly, in trading, you won't win every trade. You have to manage your capital carefully. You need the patience to wait for the right opportunities. Just like poker players study their opponents, traders study the market. And just like poker players avoid going on tilt, making emotional decisions after a loss, traders must stay emotionally balanced, even after a string of losses. Hashtag 80-20 rules. Now, let's talk about the famous 80-20 rule, also known as the Pareto principle. In trading, this means 80% of your profits will likely come from 20% of your trades. 80% of your success will depend on 20% of your actions, like sticking to your strategy, managing risk, and learning from mistakes. The key takeaway? Focus on the actions and trades that have the biggest impact. Don't waste energy trying to chase every opportunity. Instead, hone your skills and concentrate on high-quality setups, sources of funds for a trading business. One of the practical aspects of treating trading like a business is understanding where your capital comes from. The book highlights that traders must think like entrepreneurs when sourcing funds. You might start with personal savings. Some traders use funds from other investments or part-time jobs to build their trading account. It's essential to use money you can afford to lose. Risking money meant for rent or bills is a recipe for disaster. Having a solid financial foundation reduces the pressure to make money quickly, which in turn helps you make better trading decisions. Psychology behind your business plan. Finally, let's talk about the psychology behind a trading business plan. A trading plan isn't just a list of strategies, it's a psychological tool. It keeps you focused, disciplined, and emotionally grounded. A good plan includes entry and exit rules, when to buy, when to sell, and when to cut losses. Risk management, how much to risk on each trade and how to protect your capital. Performance tracking, keeping a journal to analyze what's working and what isn't. The book emphasizes that a trading plan isn't just about making money. It's about building a system that minimizes emotional decision-making. It's your roadmap to staying consistent and resilient, even when the market gets rough. Key takeaways. Treat trading like a business, not a hobby. Success comes from consistency, not luck or short-term gains. Emotional control is the foundation of good trading decisions. Embrace uncertainty and focus on probabilities, not certainties. Build a trading plan that guides your decisions and keeps you disciplined. Trading is a unique and challenging business, but with the right mindset and approach, it can also be incredibly rewarding. Remember, the market doesn't owe you anything. It's up to you to manage your emotions, stick to your plan, and treat trading like the business it truly is. Chapter 2, The Power of Resilience. This chapter is all about resilience, what it is, why it's so important in trading, and how you can build it to thrive in the unpredictable world of the markets. Let's break it down in simple, actionable steps. What is resilience? Let's start with the basics. What exactly is resilience? Resilience is your ability to bounce back after setbacks. In trading, setbacks are inevitable. You'll face losing trades, bad days, and emotional turmoil. Resilience is what keeps you going when the market beats you down. Think of resilience as a muscle. The more you work on it, the stronger it gets. Just like in life, resilient traders don't let failures define them. They learn, adapt, and come back stronger. Resilience makes a difference. So, why is resilience so crucial in trading? Imagine this. You've had a string of losing trades. You're frustrated, doubting your abilities, and tempted to quit. What separates successful traders from the rest is their ability to stay in the game despite the losses. Here's why resilience makes all the difference. 1. It keeps you consistent. Resilience helps you stick to your trading plan even when things aren't going your way. 2. It prevents emotional decision-making. When you're resilient, you don't let fear or frustration cloud your judgment. 3. It builds long-term success. Trading is a marathon, not a sprint. Resilient traders understand that losses are part of the journey and focus on the bigger picture. The authors emphasize that resilience isn't about avoiding losses, it's about handling losses the right way. How to become more resilient? Now the big question, How can you build resilience as a trader? The good news is, it's a skill you can develop with practice. Let's look at the steps. 1. Change your perspective on losses. Start viewing losses as a natural part of trading. Every trader, no matter how successful, experiences losses. It's how you respond that matters. Ask yourself after every losing trade, what can I learn from this? 2. Develop a growth mindset. A growth mindset means seeing challenges as opportunities to improve. Instead of saying, I failed, say, I learned. Focus on the process of trading rather than the results of individual trades. 3. Build emotional awareness. Pay attention to how you feel after a loss. Are you frustrated, angry, or anxious? Understanding your emotions is the first step to managing them. Tools like journaling or meditation can help you process these emotions constructively. 4. Stick to your routine. A consistent routine builds resilience. It gives you structure and helps you stay disciplined. For example, review your trading plan every morning, analyze your performance daily, and take breaks to recharge. 5. Surround yourself with support. Trading can be isolating, but you don't have to go through it alone. Join trading communities, find a mentor, or connect with other traders who understand the challenges you're facing. Sharing your experiences with others can help you stay motivated and resilient. Recovering from a bad loss. Now let's tackle one of the toughest aspects of trading: recovering from a bad loss. Here's the thing: a big loss can feel devastating. It might shake your confidence and make you question your abilities. But it's not the end of the road. Let's go over the steps to recover. Step 1. Take a break. After a significant loss, the first thing to do is step away from the markets. Give yourself time to process the emotions and clear your mind. Step 2. Analyze the loss. Ask yourself, what went wrong? Did you stick to your plan? Was the loss due to a poor decision? Or was it just bad luck? Be honest with yourself. This isn't about blaming, it's about learning. Step 3. Adjust your strategy if necessary. If the loss revealed a flaw in your trading strategy, make the necessary adjustments. For example, tighten your stop-loss levels or reconsider the market conditions you trade in. Step 4. Rebuild confidence. Start small. Place trades with reduced risk to regain confidence. Remember, one loss doesn't define your trading career. Focus on rebuilding step by step. Step 5. Seek support. Talk to fellow traders, mentors, or even a coach about the loss. Sometimes, just sharing your experience can help you gain perspective and move on. Let's summarize the big ideas from this chapter. 1. Resilience is the ability to bounce back from losses. It's a critical skill for traders. 2. Losses are inevitable. What matters is how you respond to them. 3. You can build resilience by changing your perspective, developing a growth mindset, and sticking to your routine. 4. Recovering from a bad loss requires taking a break, analyzing what went wrong, and starting fresh with a clear plan. Trading isn't just about strategies and charts, it's a mental game. Resilience is your secret weapon to survive and thrive in the markets. Remember, every great trader has faced losses. What sets them apart is their ability to learn, adapt, and keep going. So the next time you face a setback, take a deep breath. Remind yourself why you started and keep moving forward. You've got this. Chapter 3. Psychological Hazards in Trading. Averaging down. The danger of chasing losses. First up, averaging down. This is when you add more to a losing trade, hoping the market will turn in your favor. At first glance, this might seem logical. If the price drops, buying more at a lower price reduces your average cost. But here's the trap. You're throwing good money after bad. Imagine a stock you bought at $100 drops to $90. You buy more, thinking it'll rebound. Then it drops to $80, and you buy more. Before you know it, you've risked way more than planned. The authors emphasize, don't let hope replace strategy. Successful traders cut their losses quickly instead of doubling down on mistakes. Turning a day trade into a swing trade. This is a classic rookie mistake. You planned a day trade, getting in and out within hours, but the trade moves against you. Instead of taking a small loss, you decide, I'll hold it overnight. Maybe it'll recover tomorrow. What happens next? You wake up to an even bigger loss. The key lesson? Stick to your original plan. Day trades are meant to be short-term. If it's not working, exit and move on. Don't turn a bad trade into an even worse one. Blowing up your account, one bad trade. Here's a harsh truth. It only takes one bad trade to blow up your account. This happens when traders risk too much on a single position, ignoring proper risk management. Maybe you're overconfident, or maybe you're chasing losses. Either way, you're gambling, not trading. The authors stress, never risk more than 1 to 2% of your account on a single trade. This way, even a losing streak won't wipe you out. Trading is about survival first and profits second. Overtrading, crack addict trading syndrome. Next, let's talk about overtrading, or what the authors call crack addict trading syndrome. This happens when you're glued to your screen without constantly entering trades, even when there's no clear setup. Overtrading is often driven by boredom, greed, or the desire to make up for past losses. The result? You end up overexposed, making impulsive decisions and burning through your account. How do you avoid this? Set daily limits for the number of trades you'll take. Focus on quality over quantity. Remember, one great trade is better than 10 mediocre ones. Revenge trading. Letting anger take over. Revenge trading happens when you let anger or frustration take over after a loss. You tell yourself, I'll make it all back on the next trade. You rush in without a plan, taking unnecessary risks. The problem? This emotional trading often leads to even bigger losses. To break the cycle of revenge trading, 1. Take a break after a big loss. Step away from your screen and cool off. 2. Remind yourself that trading is a marathon, not a sprint. One loss doesn't define your success. Trading for money, the wrong mindset. Here's a counterintuitive truth. Trading for money is a psychological hazard. If your sole focus is on making money, you're more likely to chase trades, over-leverage, and let emotions cloud your judgment. The authors explain that successful traders focus on the process, not the profits. Your job is to execute your strategy with discipline and consistency. The money will follow as a byproduct of good trading habits. Fear and greed in your trading. Two of the biggest emotions that influence traders are fear and greed. Let's break them down. Fear. Fear of losing money can cause you to exit trades too early or avoid taking trades altogether. It's important to understand that losses are a natural part of trading. Risk management is your safety net. Greed. Greed can lead to holding on to winning trades for too long, hoping for even bigger profits. This often results in watching a profitable trade turn into a loss. The solution? Follow your plan. Set clear entry and exit points and stick to them, no matter what your emotions tell you. Fear of missing out, FOMO, chasing the market. Finally, let's talk about FOMO, the fear of missing out. You see a stock skyrocketing and you jump in late, hoping to catch the wave. But by then, the move is often over and you're left holding the bag. FOMO is driven by impatience and the desire for quick gains. To combat it, 1. Stick to your strategy. If a trade doesn't fit your criteria, let it go. 2. Remind yourself that the market is full of opportunities. Missing one trade doesn't mean you've missed your chance to succeed. Let's recap the psychological hazards we covered in this chapter. 1. Averaging down. Don't chase losses. Cut them quickly. 2. Turning day trades into swing trades. Stick to your original plan. 3. Blowing up your account. Manage risk and avoid overexposure. 4. Overtrading. Focus on quality, not quantity. 5. Revenge trading. Take a break and reset after losses. 6. Trading for money. Focus on the process, not just the profits. 7. Fear and greed. Follow your plan to avoid emotional decisions. 8. FOMO. Be patient and wait for the right setups. Trading is as much a mental game as it is a technical one. By understanding and addressing these psychological hazards, you'll not only protect your account, but also set yourself up for long-term success. Remember, every trader faces these challenges. It's how you handle them that sets you apart. So stay disciplined, stick to your plan, and don't let emotions take the driver's seat. Chapter 4, Psychological Safeguards in Trading. Chapter 4 of Mastering Trading Psychology, all about psychological safeguards in trading. These are the tools and techniques you need to protect your mental edge and stay consistent in the unpredictable world of trading. From setting daily profit targets to bouncing back from slumps, this chapter is packed with actionable insights. Let's dive in. Setting daily profit targets. Know when to stop. Many traders make the mistake of trading endlessly, trying to squeeze every dollar out of the market. But here's the reality. The longer you trade, the more likely you are to make mistakes. Why? Because trading is mentally exhausting, and emotions like greed and frustration creep in. The solution? Set a realistic daily profit target and stick to it. For example, if you aim to make $500 a day, once you hit that target, step away from the screen. It's not just about avoiding overtrading. It's about protecting your profits and ending the day on a high note. The authors emphasize that finishing your trading day with a win, no matter how small, boosts your confidence and sets a positive tone for tomorrow. Knowing when enough is enough. Hand in hand with profit targets is the idea of finishing your day. Some traders keep chasing opportunities late into the day, even when the market is slowing down. This often leads to poor decisions and unnecessary losses. Here's how to safeguard yourself. 1. Set a time limit. Decide when your trading day ends. For example, after 3 p.m., the market often becomes less predictable. This might be a good time to call it a day. 2. Review your performance. Use the end of your trading day to analyze what worked, what didn't, and how you can improve tomorrow. 3. Disconnect. Once your trading day is over, step away from your setup. Don't let the market consume your entire life. Bouncing back from a trading slump. Now let's talk about one of the toughest challenges traders face. Bouncing back from a slump. A trading slump happens when you hit a series of losses that shakes your confidence. It's not just about losing money, it's the emotional toll that makes you doubt your abilities. Here's how to recover effectively. Step 1. Pause and reflect. Take a break from trading for a day or two. Use this time to clear your mind and regain focus. Ask yourself, what's causing these losses? Am I deviating from my strategy? Step 2. Reduce your risk. When you're coming out of a slump, trade smaller position sizes. This lowers the emotional pressure and allows you to focus on execution rather than outcomes. Step 3. Revisit the basics. Go back to your trading plan and remind yourself of the rules you set. Stick to high-probability setups that you're confident in. Step 4. Stay patient. Don't try to make up for losses in one big trade. Trading is a long game. Your goal is consistency, not instant recovery. The authors stress that slumps are a natural part of trading. What matters is how you respond. Every great trader has been there. You're not alone. Learning who is behind the price of a stock. One fascinating concept in this chapter is understanding who is behind the price of a stock. The stock market isn't some magical entity. Prices move because of actions taken by traders and institutions, buyers and sellers reacting to news, earnings, and other factors. The authors explain that by learning to recognize the motivations of these market players, you can make better decisions. Here's what to look for. Retail traders, often driven by emotions like FOMO or panic. Their actions can create short-term price spikes or dips. Institutional traders, big players like hedge funds and mutual funds. They move large amounts of money and often trade based on algorithms or long-term strategies. Market makers. Their job is to create liquidity by buying and selling stocks. They can influence price movements in the short term. Understanding these players helps you interpret price action more effectively and avoid getting caught on the wrong side of a trade. Establishing clear and definite rules. Finally, let's talk about one of the most important safeguards: establishing clear and definite rules. Trading without rules is like driving without a map. You're bound to get lost. Rules give you structure and prevent you from making impulsive decisions. Here are some examples of rules every trader should have. 1. Entry and exit criteria. Know exactly when you'll enter and exit a trade based on technical or fundamental analysis. 2. Risk management. Set a maximum percentage of your account that you're willing to risk on a single trade, usually 1 to 2%. 3. Stop loss levels. Always know where you'll cut your losses. This is non-negotiable. 4. Position sizing. Decide how much capital you'll allocate to each trade. 5. Daily limits. Set maximum loss limits for the day. If you hit this limit, stop trading. By sticking to these rules, you take emotion out of the equation and trade with discipline. Let's recap the main ideas from this chapter. 1. Set daily profit targets. Know when to stop trading for the day to protect your gains and avoid overtrading. 2. Finish your day. Set a time to end your trading and review your performance. Disconnect and recharge. 3. Bounce back from slumps. Take a break, reduce risk, and stick to high probability setups to recover your confidence. 4. Learn who's behind the price. Understand the market players influencing stock prices to make better decisions. 5. Establish rules. Clear, definite rules are your roadmap to consistent trading success. Trading is more than just strategy. It's about protecting your mindset and staying disciplined. By applying the psychological safeguards in this chapter, you'll not only trade more effectively, but also enjoy a healthier relationship with the markets. Remember, trading is a journey, not a sprint. Stay disciplined, trust your process, and keep learning every day. In Chapter 5, Staying Focused, Build Your Trade Books. Talking about how to stay focused and build your trade books, tools that will help you achieve consistency in the market. We'll discuss how focus is crucial for trading success and how to avoid the common distractions that lead to underperformance. Let's get into it. Overloaded circuits, why traders underperform. Let's kick things off with the concept of overloaded circuits. Imagine trying to multitask, checking your phone, trading, replying to emails, and watching TV at the same time. It's easy to see how this would overload your brain and reduce performance, right? The same thing happens in trading. When you try to juggle too many stocks, strategies, or trades at once, you end up spreading yourself too thin. Why do traders underperform? They get distracted by irrelevant data, news, and updates. They jump between too many trades, looking for instant gratification. Their focus is scattered, and they get overwhelmed by information overload. The key takeaway here is that focus is your superpower in trading. The more focused you are, the better decisions you'll make. Focus on the process of trading. A major theme of this chapter is the importance of focusing on the process, not the outcome. Successful traders don't obsess over making money in the short term. Instead, they focus on executing their strategy consistently. Why? Because consistency leads to success over time. Think about it. The market will always have ups and downs, but your job is to stick to your proven process. That means following your entry and exit rules. It means sticking to your risk management plan. It means not getting distracted by the latest hype or rumors. If you focus on executing the process correctly, the profits will come over time. And this is exactly what separates successful traders from those who struggle. Focus on building trade books. Here's where things get interesting. Building trade books. A trade book is essentially a collection of all your past trades, analyzed and reviewed to help you improve. Why is this so important? Trade books allow you to spot patterns in your trading behavior. They help you identify what works and what doesn't, so you can improve your strategy. It becomes a valuable resource for learning from mistakes and building a solid track record. How to build your trade book. 1. Record every trade. Write down the details, why you entered the trade, your entry and exit points, the size of the trade, and the outcome. 2. Review regularly. Go back and review your trades weekly or monthly. What were your best and worst trades? What can you improve on? 3. Learn and adjust. Use this information to fine-tune your strategy and decision-making process. Building a trade book takes time, but it's one of the most powerful ways to stay disciplined and track your progress over the long run. Focus on the few stocks in play. Next, let's talk about focusing on the few stocks in play. Many traders make the mistake of trying to trade dozens of stocks at once, hoping to catch every opportunity. But here's the thing. You don't need to trade everything. Instead, focus on a small group of stocks that you know well and that have good liquidity and volatility. These are the stocks that are most likely to give you consistent, predictable moves. By focusing on a few stocks, you become more familiar with their patterns and behavior, which helps you make better decisions. It's better to master a handful of stocks than to spread yourself too thin. This approach makes it easier to stay focused, avoid distractions, and make better trades. Focus on good trading, not your P&L. A common pitfall in trading is focusing too much on your P&L, profit and loss. It's easy to get caught up in how much you're making or losing on each trade. But this emotion-driven mindset can cloud your judgment and lead to impulsive decisions. The authors explain, focus on good trading, not your P&L. The P&L will take care of itself if you focus on following your plan, managing risk, and staying disciplined. Here's why this is crucial. When you focus too much on profits, you might take unnecessary risks or deviate from your strategy. When you focus on losses, you might become fearful, hesitate, or abandon your plan altogether. The key takeaway? Trust the process. Good trading decisions lead to profits over time, and obsessing over your P&L is a distraction. Focus on only one strategy. Another essential piece of advice in this chapter is to focus on only one strategy. Many traders jump between different strategies or try to combine strategies, thinking it'll give them an edge. But this often leads to confusion and inconsistent results. Why focus on one strategy? Mastery. By sticking to one strategy, you can master it and learn to adapt it to different market conditions. Simplicity. Having one go-to strategy makes trading less stressful and easier to follow. Consistency. The more you practice the same strategy, the more consistent your results will be. You don't need to chase the latest hot strategy. Pick one, stick with it, and refine it until it's second nature. Focus on your health. Finally, let's talk about focusing on your health. Trading is mentally demanding. If your mind and body aren't in good shape, your trading will suffer. The authors stress that mental clarity and physical well-being are crucial to maintaining focus and making good decisions. Here's how you can take care of yourself. 1. Exercise regularly. A healthy body supports a healthy mind. 2. Get enough sleep. Lack of sleep can lead to poor decision-making and emotional instability. 3. Eat well. Proper nutrition helps your brain function at its best. 4. Take breaks. Don't stare at the screen for hours on end. Step away to refresh your mind. By maintaining good health, you'll be able to stay sharp, focused, and ready to tackle the challenges of trading. Let's quickly recap what we've learned in this chapter. 1. Overloaded circuits. Avoid information overload. Focus on fewer trades and stick to your process. 2. Focus on the process of trading. Consistency and execution is key. 3. Focus on building trade books. Record and review your trades to improve your decision-making. 4. Focus on the few stocks in play. Master a small number of stocks for better focus and consistent results. 5. Focus on good trading, not your P&L. Don't let profits and losses dictate your decisions. 6. Focus on only one strategy. Stick to one strategy, master it, and refine it. 7. Focus on your health. A healthy mind and body are essential for effective trading. To sum it up, staying focused in trading is all about simplifying your approach, sticking to what works, and maintaining a healthy balance in your life. By building your trade book, focusing on fewer stocks, and taking care of your mental and physical health, you're setting yourself up for long-term success. Chapter 6. Knowing yourself as a trader. This chapter is all about understanding who you are as a trader, your strengths and weaknesses, and how to align your trading style with your personal qualities. Let's break it down so you can become more self-aware and enhance your performance in the markets. Define yourself as a trader. The first step in mastering your trading psychology is to define yourself as a trader. Sounds simple, right? But many traders go through their trading journey without fully understanding who they are and what type of trader they should be. The authors stress that knowing yourself is the foundation of long-term success. Ask yourself these questions. What kind of trader am I? Are you a day trader looking for quick moves in and out of the market? Or are you more of a swing trader, holding positions for a few days or weeks? Maybe you're an investor, focusing on the long term. What's my risk tolerance? Can you handle high volatility, or do you prefer less risky trades? What's my personality? Are you analytical, relying on charts and data, or do you trust your gut and go with the flow? Understanding these things helps you build a strategy that suits your natural strengths. Trying to trade in a style that doesn't fit you can lead to frustration and loss. So take some time to reflect and define yourself. This will guide your trading decisions moving forward. Be realistic. Next, let's talk about being realistic. This is crucial. It's easy to get caught up in the idea of becoming a millionaire overnight, but the reality of trading is that success doesn't happen that quickly. Traders who expect massive profits in the short term often end up with huge losses. So what does it mean to be realistic? Set achievable goals. Instead of aiming for huge, unrealistic profits, focus on making steady, consistent gains over time. Understand your learning curve. You won't master trading overnight. Expect to go through a period of losses and learning before you start seeing consistent profits. Risk management is key. Don't risk more than you can afford to lose. Even experienced traders know that not every trade will be profitable. The key is to manage risk and minimize losses. Being realistic means setting yourself up for a sustainable path in trading. Keep your expectations in check and don't let the get-rich-quick mindset cloud your judgment. Follow no one. A common mistake traders make is following others blindly. Whether it's copying a well-known trader's moves, following tips from social media, or jumping into a stock because everyone else is talking about it, following others often leads to poor results. Why? Because every trader has their own style, strategy, and risk tolerance. What works for someone else might not work for you. The authors suggest following no one when it comes to trading. Instead, trust your own research and stick to your strategy. Develop your own approach. Build a strategy that aligns with your personality, risk tolerance, and goals. Don't chase hype. Just because a stock is trending doesn't mean it's a good buy. Stick to your analysis and stay focused on your plan. It's tempting to follow others, but true trading success comes from trusting your own judgment and taking responsibility for your trades. Self-reflection. The last key takeaway in this chapter is the importance of self-reflection. To be a successful trader, you must regularly reflect on your performance, both mentally and emotionally. This helps you understand where you're succeeding and where you're falling short. Here's how to practice effective self-reflection. 1. Review your trades. After each trade, win or loss, ask yourself, did I follow my plan? What could I have done differently? Was my decision emotionally driven or based on logic? 2. Reflect on your emotions. Trading can be an emotional roller coaster. Reflect on how you felt during your trades. Did fear or greed influence your decisions? 3. Set personal goals. Look at your progress and set realistic goals for improvement. Whether it's improving risk management or sticking to your trading plan more strictly, focus on continuous growth. Self-reflection is about holding yourself accountable and constantly improving. Trading is a journey of self-discovery, and being honest with yourself will help you evolve as a trader. Let's quickly recap the key points from this chapter. 1. Define yourself as a trader. Understand your personality, risk tolerance, and trading style to align your strategy with who you are. 2. Be realistic. Set achievable goals, manage risk, and be patient with your trading journey. 3. Follow no one. Build your own strategy based on research and personal judgment, not by copying others. 4. Self-reflection. Regularly review your trades and emotions to improve your performance and stay accountable. Knowing yourself as a trader is the secret sauce to long-term success. By defining your strengths, setting realistic expectations, trusting your own research, and reflecting on your performance, you'll build a solid foundation for your trading career. Remember, there's no one-size-fits-all formula for trading success. It's about personal growth, discipline, and self-awareness. Chapter 7, Setting Goals. Hey traders, welcome back. In today's breakdown from Mastering Trading Psychology, we're diving into Chapter 7, Setting Goals. This chapter is all about the importance of goal setting in trading and how having clear, achievable goals can drastically improve your performance. Let's break it down and see how setting goals can make all the difference in your trading journey. Defining goals. Let's start with the most important question. What are goals? In trading, goals are specific, measurable, and time-bound objectives that you set for yourself to help guide your trading career. These goals give you a clear direction and keep you focused, rather than just reacting to the market. The authors emphasize that traders without goals tend to lose focus and become driven by emotions like fear and greed, which ultimately leads to poor decision-making. But here's the key. Your goals need to be well-defined. Here's how to define your trading goals. 1. Be specific. Instead of saying, I want to make money, set a concrete goal like, I want to achieve 10% growth in my trading account over the next 3 months. 2. Make them measurable. Ensure that your goals are quantifiable. For example, I will execute 30 trades this month with a 70% win rate. 3. Set realistic timeframes. It's important to be realistic with your timelines. Don't set goals that are too ambitious, as that can lead to frustration. Start with achievable goals and gradually scale up. Why are goals so crucial? Clarity. Goals give you a clear roadmap so you know exactly what you're working towards. Focus. They help you stay focused on the most important aspects of your trading strategy, avoiding distractions. Accountability. With defined goals, it's easier to track your progress and make adjustments if necessary. The authors stress that successful traders always know what they're working towards. Without goals, it's easy to drift from trade to trade, chasing profits and making impulsive decisions. The types of trading goals. Now, let's talk about the different types of goals that can help you become a better trader. There are several areas in which you should set goals, and it's not all about making money. 1. Financial goals. These are the most common goals, and they focus on the results of your trades. Examples include, I want to increase my account balance by 20% over the next 6 months. I want to double my trading account by the end of the year. These goals are essential, but they should be paired with other types of goals to ensure you're not just chasing profits without considering the risks. 2. Process goals. These goals focus on how you trade, not just the outcomes. Examples include, I will follow my trading plan for every trade, no exceptions. I will limit my risk per trade to 1% of my account balance. I will review all my trades weekly to identify patterns and mistakes. Process goals are crucial for consistency. The more you focus on following a solid trading process, the more likely you are to see long-term success. 3. Risk management goals. These goals are all about keeping your losses under control and preserving capital. Some examples. I will cut my losses at 2% on each trade. I will use stop losses in every trade to protect my capital. Risk management is the backbone of sustainable trading, and setting clear goals around it will help ensure you don't blow up your account in a series of bad trades. 4. Emotional control goals. Trading can stir up intense emotions like fear, greed, and impatience. Emotional control is often overlooked, but is a key to long-term success. Examples include, I will not revenge trade after a loss. I will take a 10-minute break if I feel overwhelmed or frustrated. Setting goals around emotional control will help you stay calm and make logical decisions instead of impulsive ones. How to set and achieve your goals. So now that we know why goals are essential, let's talk about how to set and achieve them. 1. Write your goals down. There's power in writing things down. When you put your goals on paper or digitally, they become real. Writing your goals helps solidify them in your mind, and it's easier to hold yourself accountable. 2. Break them down into actionable steps. Big goals can be overwhelming, so break them down into smaller, more manageable tasks. If your goal is to increase your account by 20%, break that down into monthly or weekly targets. This way, you can track your progress and make adjustments as needed. 3. Track your progress. Constantly monitor your progress and adjust as necessary. Tracking helps you stay focused and allows you to see where you're improving and where you need to make changes. 4. Stay flexible. Sometimes things don't go as planned, and that's okay. If you miss a target or have a bad month, don't abandon your goals. Stay flexible, analyze what went wrong, and adjust your approach if needed. The journey is not always linear, but the important thing is to keep moving forward. 5. Celebrate small wins. Achieving big goals is great, but don't forget to celebrate the small victories along the way. This will keep you motivated and reinforce positive behavior. Whether it's hitting a small profit target or following your trading plan for a whole month, celebrate your progress. Avoid these goal-setting pitfalls. While goal setting is crucial, the authors warn about common mistakes traders make when setting their goals. Let's go over some of these so you can avoid them. 1. Setting unrealistic goals. Setting a goal to double your account every month might sound exciting, but it's highly unrealistic. Unrealistic goals set you up for disappointment and can lead to risky, emotional trading. 2. Focusing only on financial goals. If you only focus on making money, you might lose sight of the process goals that will help you improve your trading skills and consistency. 3. Setting too many goals at once. Trying to achieve too many goals at once can overwhelm you. Focus on a few key goals and don't try to change everything at once. 4. Not reviewing your goals. Setting goals and forgetting about them isn't helpful. Regularly review your goals and check your progress. Adjust your approach if necessary. Let's quickly summarize what we've covered in this chapter. 1. Define your goals. Set specific, measurable, and realistic goals that align with your trading style and risk tolerance. 2. Focus on process, risk, and emotional control goals. While financial goals are important, don't forget about process goals, risk management, and emotional control. 3. Set actionable steps. Break big goals down into smaller, manageable tasks and track your progress regularly. 4. Stay flexible and review your goals. Be open to adjusting your goals as needed and celebrate small wins along the way. 5. Avoid pitfalls. Don't set unrealistic goals. Focus only on financial gains or overwhelm yourself with too many goals. Setting goals is one of the most powerful tools in a trader's toolkit. By defining clear and realistic goals, you can stay focused, motivated, and consistent in your trading journey. Goals help you improve, stay accountable, and ultimately, become a better trader. Chapter 8. A disciplined lifestyle. This chapter is all about how your lifestyle choices, like sleep, food, and your general daily routine, impact your trading performance. A disciplined lifestyle is key to keeping your mind sharp, managing stress, and maintaining the energy needed for success in trading. So let's break it down, and I'll show you how to make small changes in your daily habits that can have a big impact on your trading results. Relationship between lifestyle and trading. First off, let's talk about the relationship between lifestyle and trading. It might seem obvious, but many traders don't realize how much their daily habits affect their performance in the market. Trading isn't just about technical skills or market knowledge. If you're not physically and mentally healthy, your decision-making will suffer, and you might find yourself making mistakes driven by fatigue, stress, or poor nutrition. A disciplined lifestyle means being aware of how everything you do, how you sleep, what you eat, how you exercise, can impact your focus, emotional control, and decision-making abilities. Remember, your mind and body are your greatest tools as a trader. If they're out of balance, it's easy to get distracted, make rash decisions, or even blow up your account. So, the idea here is simple. Taking care of yourself makes you a better trader. A winning mindset. Now let's talk about the importance of having a winning mindset. A lot of people think that trading success is all about numbers, charts, stats, and data. But honestly, your mindset is just as important as your technical skills. A winning mindset means being disciplined, patient, and emotionally stable. You need to stay focused, avoid impulsive decisions, and keep your head in the game even after a big loss or gain. How do you develop a winning mindset? Stay positive but realistic. Believe in your abilities, but don't overestimate your success. Stay grounded and understand that setbacks are part of the process. Practice self-discipline. Stick to your plan, manage your risk, and don't let emotions like fear and greed dictate your trades. Learn from your mistakes. Every loss can be a lesson. Instead of getting discouraged, look at what went wrong and how you can improve. A winning mindset is the foundation for consistent trading success, and it starts with the right lifestyle choices. Sleep. Let's move on to one of the most underrated aspects of trading, sleep. You've probably heard the saying, you can't trade if you're tired. Well, that's absolutely true. Sleep is crucial because it impacts your cognitive abilities, emotional stability, and physical health. Lack of sleep can lead to poor decision-making, increased stress, and lower concentration, which are all disastrous for a trader. So how much sleep do you need? Aim for 7 to 8 hours of quality sleep per night. This helps improve focus, decision-making, and emotional control during the day. Create a sleep routine by going to bed at the same time every night. A consistent sleep schedule trains your body to rest properly. Avoid stimulants before bed. Caffeine, for example, can mess with your sleep and leave you feeling jittery and unfocused the next day. The goal is to wake up refreshed and ready to tackle the markets with a clear mind. Food and nutrition. Next up, let's talk about food and nutrition. As a trader, the food you eat can directly affect your energy levels and mental clarity. Poor nutrition can lead to lows in energy, poor concentration, and emotional instability, all of which are horrible for your trading. Here are some tips for eating like a trader. 1. Stay hydrated. Drink plenty of water throughout the day. Dehydration can cause fatigue and impair your ability to think clearly. 2. Eat brain-boosting foods. Focus on foods that are rich in omega-3 fatty acids, antioxidants, and vitamins. Foods like salmon, walnuts, and blueberries are great for cognitive function and memory. 3. Avoid sugary snacks. Sugar can give you an energy boost, but it's followed by a sharp crash. Instead, opt for snacks that provide sustained energy, like nuts or whole grains. 4. Eat smaller, balanced meals. Rather than eating large meals that can leave you sluggish, aim for smaller meals throughout the day that keep your energy stable. A balanced diet supports your brain, your energy, and your focus. It's all about fueling your body properly to make sound decisions in the market. Changing the diet. Now, if you're used to eating junk food or don't have the best eating habits, you might need to change your diet to support your trading lifestyle. Making these changes doesn't have to be drastic. You don't need to become a nutrition expert overnight, but making a few small changes can lead to big improvements. Here's how to start. 1. Start with small changes. You don't have to overhaul your entire diet at once. Begin by cutting down on processed foods, sugary snacks, and drinks that leave you feeling sluggish. 2. Incorporate more whole foods. Add fruits, vegetables, lean proteins, and whole grains to your meals. These foods provide lasting energy and improve cognitive function. 3. Plan your meals. Don't let yourself get caught in the "I'll just eat whatever is available" trap. Plan your meals ahead of time so you have the right foods ready when hunger strikes. 4. Limit caffeine and alcohol. While caffeine might give you a temporary boost, too much can make you jittery and anxious. Alcohol, on the other hand, can disrupt sleep and affect your mood. Changing your diet isn't about depriving yourself of the foods you love. It's about making smarter choices to ensure your body and mind stay sharp. Let's quickly summarize the key points from this chapter. 1. Lifestyle and trading go hand in hand. A disciplined lifestyle is essential for trading success. What you do outside the markets impacts your performance inside them. 2. A winning mindset. Developing a winning mindset is crucial for success. Stay disciplined, stay patient, and always learn from your mistakes. 3. Sleep is non-negotiable. Aim for 7 to 8 hours of sleep to ensure your brain is sharp and ready for the day's trades. 4. Nutrition matters. Eat a balanced diet with brain-boosting foods, stay hydrated, and avoid sugary snacks to keep your energy and focus high. 5. Start changing your diet. Make gradual improvements to your diet to support your trading performance, focusing on whole, nutrient-dense foods. Remember, becoming a successful trader isn't just about what you do in front of the screen. Your lifestyle choices, sleep, food, exercise, and overall well-being are just as important as your trading strategy. By developing a disciplined lifestyle, you can ensure that your mind is clear, your emotions are controlled, and you're ready to perform at your best. Chapter 9, Conclusion. In this chapter, we'll wrap everything up and tie all the key concepts together. We've covered a lot in this book, from the psychological challenges of trading to the importance of resilience, goal setting, and maintaining a disciplined lifestyle. But how do we bring all of this together to make us better traders? Let's break it down. The key to successful trading. So, after diving into all the strategies, mindsets, and techniques for mastering trading psychology, what's the most important takeaway? The key to successful trading is understanding that trading is as much about your mind as it is about the markets. No matter how good your strategy is, how many charts you study, or how many indicators you use, if you don't have the right mindset and emotional control, you're setting yourself up for failure. In this book, we've learned that the market is unpredictable, but your response to the market is something you can control. By improving your mental discipline, focusing on your emotional well-being, and creating a solid routine, you'll be in the best position to succeed in the long term. Psychology is key. Throughout the book, the author stressed that trading psychology is the cornerstone of long-term success, from handling losses and building resilience to avoiding emotional traps like revenge trading or chasing the market. A trader's psychological state is a game changer. The psychological hazards we face, like fear, greed, and stress, can severely impact our performance. But as we've seen, by setting clear goals, building healthy habits, and maintaining a disciplined mindset, we can protect ourselves from these emotional pitfalls. Psychological safeguards, like limiting risk, sticking to a plan, and understanding our weaknesses, are key to surviving and thriving when the market gets tough. The power of consistency. Consistency is everything. In the beginning, it might be tempting to chase big profits or try to outsmart the market. But remember, trading is a marathon, not a sprint. Success in trading comes from consistent, small wins over time. This requires discipline, patience, and a long-term approach. By focusing on the process, not just the profits, you'll build the habits and skills needed to become a successful trader. Keep track of your trades, reflect on your progress, and don't let setbacks discourage you. Every trader faces challenges, but it's how you respond to them that makes all the difference. Your lifestyle matters. Remember, your lifestyle plays a huge role in your trading success. It's not just about what you do during market hours. It's about how you live your life outside of trading. In this chapter, we talked about the importance of things like sleep, nutrition, exercise, and emotional control. These aren't just nice-to-haves. They're essential for optimal performance as a trader. A winning mindset starts with a disciplined lifestyle. The healthier you are, both physically and mentally, the better equipped you'll be to handle the ups and downs of the market. Your mind is your greatest asset, so treat it like one. Goals and resilience. Another major point we touched on was the importance of setting goals and being resilient. You'll face losses. That's inevitable, but the key is to bounce back and learn from them. As we discussed earlier, setting clear, actionable goals and keeping a resilient mindset can help you recover quickly from bad trades. And when you set realistic goals, you'll always have something to work toward, keeping you motivated and focused on improving. Being resilient also means knowing when to step away and regroup. It's okay to take a break, reset, and come back stronger. Trading isn't about constant action. It's about smart, calculated moves. Final thoughts on becoming a master trader. So, what's the final takeaway? If you want to be a master trader, you need to work on both your technical skills and your psychological skills. Trading is more than just numbers. It's about how you manage your emotions, your mindset, and your behavior in the face of uncertainty. By embracing the principles in this book, like setting clear goals, maintaining emotional control, living a disciplined lifestyle, and focusing on continuous improvement, you'll be well on your way to becoming the best trader you can be. Remember, trading isn't a quick path to riches, but with the right mindset and the right habits, it can be a rewarding journey. Stay patient, stay focused, and keep learning. Key takeaways. 1. Psychology is everything. Your mindset and emotional control are just as important as your trading strategy. 2. Stay disciplined. A disciplined lifestyle, healthy habits, consistent routines supports success in trading. 3. Consistency over time. Success in trading comes from consistent, small wins, not from chasing big profits. 4. Set goals and be resilient. Clear, realistic goals and the ability to bounce back from losses are essential for long-term success. 5. Your mind is your biggest asset. Take care of your mental and physical health to perform at your best. Wrapping up, that's a wrap on mastering trading psychology. I hope this book breakdown has given you valuable insights into how to approach trading with the right mindset and discipline. If you're serious about trading, remember, it's not just about what happens in the market, it's about how you handle it mentally. If you found this useful, don't forget to hit that like button, share it with your fellow traders, and subscribe for more insights. Keep practicing, stay disciplined, and keep working toward your trading goals. Until next time, Happy trading.